Happy Liberation Week, everybody, or should I say Liquidation Week. The markets are absolutely tanking right now off of this tariff announcement that came yesterday. We have a lot of information to discuss in this video, guys, but the one thing that I think a lot of investors need to understand right now, and this is something that I've been talking about time and time again with my private community here, is that just because you are seeing some drawdowns in certain individual names, it does not mean that you should be going out and buying these individual stocks just because they are down. If you already have a nice dollar cost averaging plan in place, a scheduled system in order to put money into the market, that's great, and you should definitely keep that system going. But for those of you guys that are looking to add and be a little bit more discretionary, remember that three-pillared approach that I have in order to initiate a lot of these new positions, it really starts off with that macro big picture view, and that view right now is telling us to sit on our hands and wait. That is sometimes the hardest thing to do as an investor or as a trader, but it is necessary and absolutely critical that you understand that those times in the market are the ones that you can really take full advantage of in order to make sure that you're going to outperform for the long run. So guys, we're going to play this Tom Lee clip here. We're going to break down a lot of these statements and make sure that you guys have better information than you would have had otherwise going into the next couple of trading days and weeks. So guys, before we get into all of that information, if you guys do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you absolutely nothing to do it, but it helps me out a boatload in spreading these videos out to as many people who actually want to learn. Let's see if we can hit 500 likes. That would be awesome. And again, make sure that you guys are subscribed and turn on notifications so you never miss another one of these videos once they go live. We are almost at that 90,000 subscriber threshold there, guys. That'd be awesome to be able to hit by my birthday at the end of May. So again, make sure you guys are subscribed, but let's roll the clip here and get into all of the information.
Today is Tariff Liberation Day. I think the outcome was a negative surprise for myself and for markets. But before you think that this means all bets are off and the US is headed for calamity, let me walk you through these 5 points. Why the Tariff Liberation Day, while it's a negative surprise, I think is actually going to have surprisingly, I think, positive outcome. The first thing I just want to point out is the tariff rates that were revealed are just too absurd to believe are sustainable. Let me explain what these numbers are. The executive order starts with a base rate of 10%. And I think that's reasonable because investors were, of course, worried about a 15% tariff rate. So 10% is below expectations. But then for an additional 60 countries, there's a higher duty. And this is the table, a snapshot of the table that the White House exhibited. But to give you an example, at China, they calculated China's tariff at 67%, and the US is going to charge 34%. Now, I want to explain why not only are the numbers huge, 34%, but their calculation is actually a little bizarre. These are not the official tariff rates, for instance, that China charges US products, but it seems to be a rather odd calculation of the trade deficit itself as a ratio. I just want to give you some examples again. China at 67% versus 30. So the tariff rate is US is charging 34%. Or for the EU, 39% versus 20. Okay, but you want to know, how do you get this 39%? Well, some people have crunched the numbers, and this is from Evan Kirstel, but many people have done similar calculations. It looks like they're actually just calculating a ratio of the trade deficit as a ratio of the imports. In other words, is the imports that we're importing relative to the amount of sort of net deficit that's created. And that's what they're calculating as the tariff charge to USA. Now, of course, there are some exemptions, so it's not like every product is being tariffed. The exemptions listed are copper, pharmaceuticals, semiconductors, lumber, certain critical minerals, and energy products. Some of these are not surprising, but to me, this really does indicate the US obviously wants to keep the supply chain open for not only power, but for AI-related things. That's the semiconductors and the critical minerals. Now, the third point I want to make is that I think there's plenty of signs that President Trump actually wants to make a deal. Now, that's not what you're going to necessarily hear because there's going to be a lot of folks up in arms about this, but keep in mind a few things. The tariffs of the 10% start April 5th. So that is, a couple days away. But the higher rate, these 39%, et cetera, start April 9th, which is a week from now. So there's essentially a clock ticking for countries to have 1 week to sort of respond to this. And in the executive order itself, it says, should any trading partner take significant steps to remedy the non-reciprocal trade agreements and align sufficiently with the United States on economic and national security matters, I may further modify or decrease or limit in scope the duties imposed under this order. And during the White House Rose Garden briefing, President Trump himself said, likewise, to all foreign residents, prime ministers, kings, queens, ambassadors, and everyone else who will soon be calling to ask for exemptions from these tariffs, I say, terminate your own tariffs, drop your barriers, don't manipulate our currencies. So clearly, I think President Trump wants a deal.
So there's a couple of really important points here that we have to break down in this Tom Lee clip. The first is really the reasoning and methodology behind these new tariffs, and two is kind of this open-ended situation where the Trump administration could come to some sort of agreements with a lot of these other countries that have been really slapped with very, very aggressive tariffs. Now, when we move over here and start thinking about kind of this methodology for these new tariffs here, it is a bit strange. The White House announced sweeping new tariffs that sparked a sharp market reaction, but deeper analysis reveals their foundation is shaky. The baseline 10% tariff on all imports was initially perceived as a relief. That's why you saw the markets initially bounce when that speech was happening in the Rose Garden yesterday. However, an additional country-specific surcharge based on a dubious reciprocal tariff formula radically changes the narrative. These reciprocal rates are based on a strange calculation derived from the U.S. trade deficit divided by import value. Now, when you think about the actual goals of these tariffs now versus what has been said in the past, and also some of the guidance that we have seen in statements really from Lutnick and Besson, well, one of the main goals that they have over this the course of this administration is to balance the budget and shrink this deficit that the United States has every single year. So it looks like right now that if these tariffs were to stay in place, and as you guys saw from that Tom Lee clip, they're almost too aggressive to actually believe. What they're really focusing in on is trying to balance this deficit here versus just imposing these reciprocal tariffs. Now, again, it is interesting that some of these tariffs are going to affect immediately, but these reciprocal tariffs do have a little bit of time in order for them to actually go into effect. And we've seen a lot of statements coming out today that there is room for negotiations to get these rates lower. Now, one of these in particular has actually been outlined today when we think about China, and Lutnick did come out in an interview and start to say that we could easily see negotiations starting with China. So China-U.S. negotiations likely soon, say Chinese advisors. Trade negotiations between China and the U.S. are likely to start soon, but given Donald Trump's penchant for deal-making, but a quick settlement looks difficult, with China calculating that the U.S. position will be weakened by a deterioration of its economy and markets, Chinese policy advisors told MNI. Again, guys, if you've been paying attention to all of the content that I've been providing you guys over the last couple of weeks here, consumer sentiment is in the gutter. We see those Atlanta Fed GDP estimates falling through the absolute floor, and that could easily put the United States and the Trump administration in an adverse position through these negotiations. And then you come over here and talk about what Lutnick said. Lutnick, 20% China tariff would drop if Xi orders fentanyl cuts. Now, I think, again, like I said at the beginning of this video, what we really need to focus on is what happens next. These tariffs right now, guys, they might stay in place and they might not, but we are not going to know until they go into effect or not on April 9th. And that is what I want all investors to really be focusing in on right now, is we have to be able to see the board in front of us and not make any knee-jerk reactions in the present, because things can always change. And speaking about what happens next, it is very possible that these tariffs do lead to inflation across the board here and also lead to a decrease in United States GDP in the short term. When we come over here and take a look at this note from JP Morgan here, on a static basis, today's announcement would raise just under $400 billion in revenue, or about 1.3% of GDP, which would be the largest tax increase since the Revenue Act of 1968. We estimate that today's announced measures could boost PCE prices by 1 to 1.5% this year, and we believe the inflationary effects would mostly be realized in the middle quarters of this year. The resulting hit to purchasing power could take real disposable income growth in the second quarter and third quarter into negative territory, and with it, the risk that real consumer spending could also contract in these quarters. Guys, a significant portion of the United States GDP every single year is solely due to consumption based on consumer spending. If the consumer has less disposable income and real disposable income, well, they are not going to be able to provide that boost to the economy, especially when prices are moving to the upside there, if we end up seeing that happen. Then we have a comment here from Dan Ives of Wedbush here. President Trump's latest slate of tariffs will be shown and written about for years to come, because they are so logical and absurd. Wedbush says in a recent note, President Trump stunned markets by announcing a suite of tariff hikes on major trading partners, including the 20% for the European Union and 34% on China. Wedbush says the tariff numbers shown by President Trump were factually incorrect of what other countries charge the U.S. Remember, they're using almost like an adjusted tariff rate there, in really focusing in on what the deficit is between the U.S. and these individual countries versus the actual tariff rate. We have to assume that this is the start of a negotiation, and these rates will not hold. Ultimately, our view is these numbers would throw the U.S. into a clear recession and cause stagflation almost immediately if they hold. Now, all of this volatility and uncertainty surrounding this new tariff policy is, again, obviously why growth expectations have fallen through the floor, and these one-year inflation expectations have moved up to 5% in that survey that we've covered many, many times on this channel here. But what I want to bring your guys' attention to is, okay, with the people that are putting actual risk on with these expectations, what are they actually thinking is going to happen next? And there's a couple of different charts that I want to show you guys in order to illustrate this. So one is the chart of US 10-year Treasury yields. So with what we're seeing here, there is a massive rotation into fixed income. Now, you could say that this is a flight to safety, but when you look at Treasury yields on the shorter end as well, when you look at the 3-year or even the 2-year Treasury yields right here, so we can look at the 3-year right here, also falling through the floor. You can look at the 2-year falling through the floor here as well. Let me pull this up for you guys as well. What we're seeing here is a very, very interesting shift that's a little bit different than what you're seeing in the news headlines. If we were to see entrenched inflation, you have to think about what happens to the value of domestic currency. If prices are going up and the purchasing power is going down, well, your currency is going to lose in value versus a lot of the other currencies. Now, we're kind of seeing that in the dollar today too, but there's also a different dynamic that we also have to touch upon. So if your purchasing power, the value of the dollar is going to decrease, when you look at fixed income, you are then going to require a higher rate of return. So the exact opposite move in Treasury yields would be happening in the bond market right now than what we're seeing right now. You would not be seeing Treasuries absolutely getting bid up like crazy and yields falling through the floor like we're seeing here. Now, when you think about the dollar move here, you also have to think about this overarching thesis that many people have had and been very, very correct on over the last year here, that there has been such a large concentration in United States assets because it's really been the only game in town. But you have started to see a lot of repatriation happening, which is effectively taking your money back from a foreign country and moving it back into your domestic currency. Now, there could be a couple of different reasons for this. One, you might be thinking there might be some economic uncertainty at home, and you might want to bring that money back so that you have more of your domestic currency in order to spend or invest in whatever you want to in your domestic country. And yeah, as you guys have all seen this year, a lot of these foreign markets have continuously outperformed U.S. markets. We look at China right now. We all know China's been outperforming U.S. so far this year. FXI, the China large cap ETF today, is only down 1%, even after the S&P is absolutely tanking. You look at Mexico, who just got slapped with pretty significant tariffs as well. Mexico is up 5.48%, kind of based off of the fact that they didn't get any additional tariffs, but still looking this year, wild outperformance versus the U.S. markets. EWC right here, Canada. Canada is only down about 1% today as well. So you could look at the dollar today and say, okay, it's moving down significantly. This could be a forecast of potentially more inflation to come, more debasement of currency. But the bond market isn't really saying that. And then when you also look at the comparison between the U.S. equity markets in these foreign markets today, the argument leans more towards that there is a large-scale repatriation happening right now. And I don't think many people are paying attention to that. So what I really want everybody to understand here is this is not the end of the volatility. We are going to see a lot of whipsawing moves over the next couple of days and really weeks here. We have non-farm payrolls coming out on Friday. We have Jerome Powell speaking on Friday as well. We have this kind of new deadline on April 9th over whether or not these new tariffs are actually going to get put into effect. Over this weekend, we're probably going to see a lot of headlines coming out on some of these new negotiations. We've seen China. We're seeing a little bit out of France right now as well. But it is likely right now that a lot of these different countries are going to come to the table and try and come to an agreement with the United States in order to make sure, again, that the global economy doesn't really slip into recessionary territory there. So again, kind of going over everything and just kind of reiterating that point that I made before, that again, a lot of people are going to rush into this market too quickly and say, oh, this is the bottom. Oh, this is it. This situation, guys, is moving so fast in either direction that it does not make sense. And again, this is something that I've been talking about with the private community so much over the last couple of weeks here, that when you start from that big picture macro view, it becomes very easy to see if those kind of signals are flashing you a green light, a yellow light, or a red light there. And right now, the markets are really flashing a red light saying, hey, this is the time to sit back, wait and see what happens next, and then kind of recalibrate to see, okay, is this a time that we actually need to be putting more capital into the market, or is it a time to sit back, relax, and see how this situation continues to develop? So guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis that I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you are subscribed and turn on notifications so you're notified every time these videos go live. But team, until next time, I will see you. Peace.